Moving on to our next, I'm sure that you'd like to know what has worked for equities in India. We have our next session. For this, I'd like to invite on stage Mr. Vinay Paharia, CIO Union Mutual Funds. He's going to be answering to this pertinent question that we all always ask. He's the Chief Investment Officer of Union EMC. He's become an MMS. In his professional career of more than 20 years, he's worked with Invesco Asset Management as fund manager. He's also worked with DBS, Cholamandalam, AMC, KR, and Choksi Shares and Securities, and First Global Stockbroking as an equity research analyst. Ladies and gentlemen, please welcome on stage Mr. Vinay Paharia.
Um, Thank you, Cafemutual, for giving us this platform. Um, so the topic for me today is what has worked for equities in India. And this is sort of an adaptation of something which has already been documented in the form of what has worked on for Wall Street. So we decided to do something for what has worked for equities in India, right? No such study was done. We being a fund house which is more process driven, we wanted to see what actually does better for investors and in terms of returns, because we don't want to rely on fund manager hunch, fund managers intuition, and so on and so forth. So we wanted to see quantitatively what has worked. So without wasting too much time, we'll look at what is this study all about, and we'll just discuss the outcomes of this study. As I said, our objective was to understand objectively what things have done well and what has not done well. So this is the broad research methodology. We looked at almost 1,700 companies, and we looked at this data for the last 12 years, from 2010 onwards. And some of the other things which we highlighted is that we have used median as a measure of central tendency. We divided the entire set into 3 baskets. When you look at, in fact, this is one of the key features of the study, that generally most of these studies which are done by professors, etc., they do not divide the entire universe adequately. So we have tried to do that, group the financials, NBFCs, and non-financials and NBFCs together, so that these are the 3 baskets. That's another important characteristic. And then we have also tried to look at which of those factors are responsible for generating superior returns. So we have looked at 4 factors: growth, quality, value, and momentum. This is the first edition of the study. We do not want to complicate into more other factors and also permutations of these factors. So we just talked about these 4 factors in the first edition. There are two types of studies for each factor. One is, we looked at what happens if a simple computer took this entire data and constructed the portfolio. He constructs the portfolio of 2 parts. One is, for example, companies which have grown fast in the previous 3 years. He takes all of those. And the second portfolio is companies which have grown at a slower pace in the previous 3 years. So this is called retrospective analysis, which a computer can do it, right? So we have tried to look at that. And then we looked at what is the returns of both these baskets. So for example, H1 above average growth portfolio and below average growth portfolio, what is the median return of all of these? So these are almost 850 plus, companies, and hence a fairly large data set. And this is not biased by 1 or 2 companies, by market caps, etc. So pretty large, extensive database, not getting biased. What we saw is clearly market has preferred growth. In 9 out of these rolling, in total 9 periods which were part of this study of rolling 3 years data, 7 times growth has done well, except the last 2 years, which were COVID periods. Now, this is the retrospective study. And we have done this same analysis for the other 3 factors as well. Then we look at the prospective study. What is prospective study? Suppose you can forecast the future growth, not with complete accuracy up to the last decimal points, no one can do that, but at least you are able to create 2 baskets of portfolios, forecasting that chalo, one portfolio is going to grow faster in terms of earnings, and the second portfolio of companies which are going to see slower growth in earnings. That's the only differentiation you want to do in terms of forecasts. And then we looked at what has happened in the past. How much is the growth playing a role in terms of returns? And what we saw is astounding. Markets have actually rewarded future growth significantly. Almost all times, 9 out of 9 times, portfolios of companies which have grown faster have actually delivered superior returns compared to companies which have grown slower. Now, we'll quickly look at the results. In terms of quality study, we looked at companies from a return on capital employed perspective. Once again, we have tried to apply it a buy-side perspective, not the routine returns on equity and pulled out from database, etc. We cleaned out the data. We removed extraordinary expenses, extraordinary income, and tried to look at the clean core returns on capital. And then we sorted these companies, almost 1,700 companies, into good and bad. So once again, the results were clearly favoring quality. So companies which are having superior returns on capital or superior quality have delivered much superior returns compared to poor quality companies. Pretty obvious, but the market data also supports that. And if you are able to forecast the quality, and why is forecasting important? For the simple reason, let's say you are looking at commodity companies. Today their returns on equities are very strong, but tomorrow it may not be, right? So you just need to look at companies which are having a sustainable return on equity. What could be the potential returns? So once again, forward-looking quality is far more important than backward-looking quality. That's the result. Third is value. I think a lot of people have talked about value as a factor. So in value, we looked at not the simple PE multiple. We tried to look at EV by EBIT, which removes the impact of leverage and cleans out most of the companies and makes them apples to apples comparable. What we found out is, once again, cheaper companies have done better than expensive. All of these are pretty well known, understood, right? But the empirical studies are also supporting that. And once again, if you are able to look at forward earnings, and then forward valuations are more important than backward valuation. And the last factor is very interesting, momentum. I think it's the talk of town. A lot of people have talked about it, so we tried to test it. Momentum is nothing but what it tells us is that if stock prices are doing well for companies, in future they will do well. And if companies' stock prices are not doing well now, they will not do well in future. So we tried to test it for all of these 1,700 companies and divided them into 2 parts, strong momentum, weak momentum. What happened is, once again, interesting outcomes. Momentum did well for 6 times out of 9. So pretty good outcome for a retrospective study. So broad conclusion of all of this is summarized here, maybe useful for a quick snapshot. If you look at the data, all of these 4 factors clearly contributed to superior returns, even on a retrospective basis. So if a computer is creating these portfolios, the computer would possibly also deliver superior returns. But if you are able to do a little bit more of forecasting, the potential for returns is far, far superior. And the conclusion of all of this is that yes, quantitative factors are important, but forecasting is equally important, and hence don't try to remove the human element out of investing. And hence what we concluded is that quantitative plus fundamental analysis works the best, and hence quantamental potentially can deliver much superior returns. So that was the broad study. We thought we'll also present to you a very quick snapshot of one more popular valuation myth. So generally, when you most of the clients, investors look at markets, the first question is market kya lagta hai, right, to fund manager. So and the standard answer is I as fund manager historically used to look at average P multiple of the market. If the multiple today is higher, I will tell that my valuation is high, but over a long term India's growth story is good, so remain invested, right? That's the popular standard approach. What we tried to do is we once again went into details whether the metric which we are using, which is Nifty P multiple or Sensex P multiple or Nifty price to book, is it the right metric? And I'll tell you why. So first, in simple words, what we are trying to say first is, what is fair value in simple words? It is nothing but it's a multiple to value driver. So look at, so let's say the value driver is core book value or core earnings. We apply to that a multiple. People talk about it as a P multiple, and everyone has their own opinion on P multiple, whether P multiple is good or bad, etc., etc. We have said once again it is very mathematical, derived from solid theory. It is not something which is very subjective that so IT companies should have this much P multiple, steel companies should have this, that much. There is science. And the science is, it is derived out of 4 factors. First is returns on equity on a long range basis, sustainable growth, the risk-free rate of return, and the riskiness of the underlying business. I won't spend too much time on this, but suffice it to say, all of these factors are ingrained in theory, and we have looked at it in practice. Markets are not irrational. They do look at all of these 4 factors, and multiples given by the market are very much in sync with these 4 factors. So first we derive fair value of individual companies, and then we arrive at the fair value of the markets. We started with this Nifty P multiple, Sensex P multiple. The point which we are wanting to highlight is that this metric is a flawed metric. Not that the calculation is wrong, it is absolutely calculated perfectly in the right manner up to the next 2 decimal points, but there are arithmetical challenges in interpretation. So for example, if you change the composition of Nifty, suddenly the P multiple may go up or down without the underlying changes. Right? So I think that is a potential threat. I won't go deeper into that, but we have published a complete white paper on the problems of using this, and this white paper contains the complete arithmetical details of what are the problems of using a P multiple in judging market. The conclusion is, don't use a P multiple. It is arithmetically, it's an arithmetical problem. So this chart gives you some more details on this policy. If you look at Nifty, for example, Nifty has grown at whatever returns, 15% plus in the past 10 years. And most popular discussion on news channels till some time back was Nifty has given XYZ percentage returns, but corporate India is not giving, the profits have not grown fast. The corporate profits have grown at just 4-5%, and when they are referring to corporate profits, they are actually referring to Nifty EPS. And Nifty EPS was only growing at 4-5% because of arithmetical reasons, not because that the underlying companies were not growing. The underlying companies were growing fast, which was reflected in the fair values. The underlying fair value of the index was completely in sync with what the market was delivering. So markets were reasonably efficient, and one cannot just look at multiples and comment that it is good or bad. So I won't go too much into examples. We had put it up, but there is paucity of time. So what I will do is quickly jump to the summary. And the key parts of the summary are that don't conclude that high PE multiple is expensive and low PE multiple is cheap. It may not be the correct approach. In fact, it is not the correct approach. The correct approach is, if a company's valuation is higher than its fair value, then it is expensive, and vice versa. Factors to consider while judging the valuations are largely what is the riskiness of the business, what is the sustainable earnings growth or the returns on equity, and what is the price to value. Beware of index EPS growth or slowdown, because that does not indicate anything. I will repeat, don't do that mistake. Refer to these white papers. We will be happy to share. All of this is available for free on our websites. So feel free to download and read it. And very importantly, last thought which I want to leave the audience with is, remember, equity is the highest duration asset available in the market in terms of asset classes. So don't write off interest rates without remembering this. If interest rates go up, it has a negative effect on valuation and vice versa. That I will stop here. Thank you.